Hello and welcome to AI Market News by LM. Before we jump in, just a quick but important note. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources we use for this summary are listed in the video description. And because this content is AI generated, there might be some errors in names, pronunciation, or maybe some unnatural speech here and there. And one last thing. This video doesn't provide investment or trading advice. Please make investment decisions at your own discretion. All right, let's unpack this. Today, we're diving deep into the intricate tapestry of global financial markets as of September 4, 2025. We've compiled a really fascinating stack of resources that paints quite a clear picture, I think, of what's driving things, everything from major currency pairs to U.S. equities and those crucial macroeconomic indicators.
Absolutely. And what's truly fascinating here is how incredibly interconnected all these elements are. It's this complex web of cause and effect. So our goal for this deep dive is really to synthesize these diverse insights, helping us understand not just what's happening on the surface, but why it matters for us as market watchers. We'll look for those, hidden patterns and maybe some surprising connections to provide a structured but still engaging summary of the overall market landscape.
Exactly. Think of it as navigating a market at a crossroads. You've got central bank policy, geopolitical tensions, shifting economic data, all pulling in, different directions. Let's start right here at home. In the U.S., the economy is certainly sending us some mixed signals. What's the latest on jobs data? How's that influencing expectations for the Federal Reserve?
Yeah, based on the prepared resources, the recent U.S. jobs data has come in notably weaker than expected. It does signal a potential cooling in the labor market. For instance, the JOLT tests data, that's the job openings and labor turnover survey, a key barometer really of labor demand, it revealed a significant drop, down to 7.18 million job openings, which marks a 10-month low.
Wow, 10-month low. Okay.
And then you have the ADP non-farm employment change for August. That came in at just 73,000 against a forecast of, I think it was, 104,000.
Big miss.
Yeah. And initial jobless claims stood at 230,000, slightly above the 229,000 forecast. Continuing jobless claims at 1,960,000. So this collective slowdown, it's certainly reinforcing those market bets for potential Fed easing. The economy is showing signs of losing a bit of steam.
Okay, so if the labor market is softening like that, what does this all mean for the Fed's next move? Could tomorrow's key U.S. employment report pave the way for a more aggressive, say, 50 basis point rate cut? That's a 0.5% cut? Or is the Fed still kind of divided on this?
Well, this really raises an important question about the Fed's immediate policy path. I mean, the market, if you look at the CME FedWatch tool, it's actively pricing in rate cut probabilities, clearly leaning towards easing. However, inside the Federal Reserve itself, we're seeing a notable divergence of opinions. Governor Waller, for example, recently favored multiple cuts in the months ahead. That suggests a more dovish stance.
Okay.
But then Raphael Bostic suggested just one cut is appropriate for this year. And St. Louis Fed President Musalem believes the current policy rate setting is actually, quote, in a good place.
So quite a range there.
Exactly. So while the data might be, screaming for cuts, the Fed's internal divisions highlight this fundamental lack of consensus. It's not just about rate probabilities. It's a real tightrope walk for investors trying to figure out this fractured central bank narrative.
That's a crucial point. And it leads us directly into another really hot topic right now. The growing concerns about the Federal Reserve's independence. We've seen this narrative gaining some serious traction.
Indeed. As seen in various news commentary, the issue of central bank independence has really become a flashpoint. President Trump has intensified his attacks on the Fed. There were attempts to oust officials like Lisa Cook, influence key appointments. This has led former Treasury Secretary Larry Summers to warn of a looming credibility crisis for the institution.
And it's not just a domestic U.S. issue, is it? We're also seeing Andrew Bailey, governor of the Bank of England, and the Bank of Thailand governor voicing concerns about this globally. They're emphasizing that central bank independence is absolutely crucial for financial stability. Today, actually, September 4th, Trump's Fed nominee, Stephen Meyernold, is scheduled for a Senate confirmation hearing. He's expected to affirm his commitment to Fed independence. It'll be very interesting to see how that plays out.
And if we connect this to the bigger picture, the insight here isn't just that Trump is attacking the Fed, but the profound global concern it's sparking. Senator Elizabeth Warren, for instance, is pushing for the Senate Banking Committee to address these attacks before confirming nominees. She argues, and it's a strong argument, that undermining this independence could lead to severe economic instability. She references cases like Turkey, where political interference saw interest rates, quote, shoot through the roof.
Right, that's a stark warning.
It is. It suggests the impact isn't just theoretical. It really brings home the global concern around this issue. It makes it feel like a credibility crisis, not just, a political spat.
Absolutely. It certainly adds another layer of uncertainty to the market, doesn't it? Now, shifting gears a bit from policy and politics to actual performance. How have U.S. equity markets been reacting amidst all these complex economic signals? Are they holding up?
Well, they're holding a bit of a mixed bag today, but the general trend recently has been positive. According to finviz.com, S&P 500 futures right now are up about 0.17% at 6468.25. NASDAQ 100 futures also in the green, up 0.25% at 2350.7.75. The Dow futures, though, are slightly down, just 0.03% at 45294.00. But looking broader, based on other market analysis, the S&P 500's year-to-date return was actually a pretty robust 9.84% as of August.
Okay, still pretty strong year-to-date then.
Yeah, and this performance has been supported by corporate earnings and relatively contained inflation. The PCE inflation rate, that's personal consumption expenditures, the Fed's preferred gauge, it's at 2.9%, and we saw a 0.5% increase in consumer spending back in July. So some strength remains, but maybe with a bit more cautious optimism now.
That's a helpful overview of the U.S. picture. Let's pivot now to the global currency landscape.
Right.
What are the key dynamics influencing major pairs like, say, EURUSD and USD-JPY today, especially with these shifting narratives?
Okay, looking at the prepared resources, the USD pair is currently trading around 1.1644. It's showing a slight decrease today, about 0.14%. For USD-JPY, we see it at 148.32, that's up 0.20%. And the GBP-USD stands at 1.3438, with just a minor dip of 1.04%. So these movements really reflect a mosaic of factors at play.
Right. Focusing on USD then, considering the ECB's own policy path, what's the short-term outlook for the euro? Is there much upside there?
Well, based on market analysis, the short-term upside for the euro appears quite limited. Given the European Central Bank's expected rate cuts, plus, the inherent structural weakness in the European economy, a trading range between 1.10 and 1.5 is widely suggested as the likely path.
So kind of stuck in a range.
Pretty much. While some believe a rebound could occur if U.S. dollar strength significantly weakens, the underlying economic fundamentals in Europe don't really point to a strong rallying cry for the euro right now.
Okay. And what about the Japanese yen? It seems to be under this persistent pressure, hovering around that 148 per dollar level. What's keeping it elevated despite other global currency moves?
Yeah, the yen's weakness around 148 is a fascinating case study in the impact of political risk. It's staying elevated primarily due to ongoing political instability in Japan. There's next week's potential LDP leadership contest. That's the Liberal Democratic Party on September 8th. That's casting a shadow.
Ah, the leadership contest.
Yep, exactly. And despite a pretty smooth 30-year Japanese bond auction, where the yield touched 3.285% on Wednesday, this political risk premium is just preventing the yen from following its typical rate trajectory. Some forecasts are even suggesting it could test that crucial 150 level.
Wow, 150.
It really underscores how domestic political uncertainty can sometimes override those traditional economic drivers in currency markets.
So that political risk isn't just isolated to the yen. It kind of echoes that broader theme we talked about with the Fed, central bank credibility, market stability. Speaking of major global themes, let's broaden our lens to China. What's shaping the global economic narrative right now, particularly concerning the Chinese market?
Well, according to various news commentary, Chinese regulators seem to be eyeing measures to cool down stock speculation. There are concerns about a liquidity-driven rally and potential bubbles forming.
The classic balancing act.
Exactly. They want to support the market, but without letting it overheat unsustainably. However, underneath that, the underlying fundamentals, driven by a strong AI story and these proactive policy initiatives to support consumption, they still offer significant support for Chinese equities.
It does sound like a delicate balance. What's the sentiment among major institutions regarding China's market, given these sort of cross-currents?
Well, Goldman Sachs recently raised its target for China A shares. That suggests further upside potential, which is a pretty significant endorsement. Their analysis indicates that while retail sentiment is indeed elevated, it's, quote, nowhere near the extremes seen about a decade ago. That implies the market isn't necessarily overextended or, on the brink of collapse.
Interesting. So not bubble territory yet, according to them.
Seems to be their take. And this renewed confidence is partly attributed to a perceived shift in the leadership stance towards private enterprises, especially tech companies, after President Xi Jinping's more recent meetings with industry leaders. Suggests a more supportive policy environment might be emerging.
That's a strong bullish signal from Goldman. But are there any dissenting voices or significant risks highlighted in our sources that maybe temper that optimism? Perhaps around ongoing regulatory uncertainty or the broader economic slowdown?
That's a fair question. And while Goldman is optimistic, the broader narrative definitely acknowledges those risks. The specter of regulatory tightening, even if it seems softened right now, it always remains. And the overall macroeconomic growth figures for China still present some challenges. So the optimism from Goldman seems more focused on maybe a re-rating based on these policy shifts, rather than a fundamental breakout driven by overwhelming economic strength.
Got it. Makes sense. Moving beyond economic fundamentals then, what about the broader geopolitical stage?
Yeah.
Especially concerning trade relations, that seems to be a constant source of market volatility.
Oh, definitely. As seen in the provided information, President Trump is indeed taking his global tariff case to the Supreme Court, seeking an expedited review. He's even suggested that existing trade agreements with partners like the EU, Japan, South Korea could potentially be, quote, unwound if his tariffs are ruled illegal.
Wow, that creates significant uncertainty.
Huge uncertainty. Trade policy becoming a legal battleground. Meanwhile, China has already imposed those 38% levies on U.S. inputs, set to last until April 2028. Shows the tit-for-tat nature of these disputes isn't going away.
And we've also seen Trump imposing those 50% tariffs on India for buying Russian crude. That signals another escalation, right? Pressure on a key emerging market.
Yeah.
How's India responding?
India is taking pretty swift steps to mitigate the impact. They're lowering nationwide consumption taxes. Those come into effect September 22nd, trying to boost domestic demand and shield their economy. The implication here is a sort of domestic-focused strategy to offset these external pressures. But it also highlights this economic nationalism that's really becoming a defining characteristic of global trade, forcing nations to kind of internalize their growth drivers.
That's a lot to process. It really paints a picture of the pressures the global economy is facing. Let's talk about gold. It's been consistently in the news, seems to be thriving in this environment. What's driving its current performance?
Gold is certainly having a moment, isn't it? Holding near record highs, currently around $594.80 per ounce. It has come off just a bit after a significant run. This rally is largely fueled by optimism for Fed rate cuts, which typically weakens the dollar and makes gold more attractive as an alternative store of value.
Right, the classic relationship.
Exactly. But analysts like Goldman Sachs again are even suggesting a, quote, tail risk scenario where gold could reach an astonishing $4,500.
4,500, wow.
Yeah, it indicates that gold is increasingly seen as a true safe haven, hedging against not just a potential recession, but also these growing risks associated with perceived threats to central bank independence, broader geopolitical instability. It's really a flight to quality in uncertain times.
Makes sense. And what about the oil market? We often see its movements tied to inflation and global growth narratives. What's the situation there?
Brent crude oil is a bit softer today, trading around $67 per barrel. The primary concern right now is about a potential supply glut. There's an upcoming OPEC Plus meeting, that's OPEC plus other major oil producers, scheduled for this weekend. They're meeting to determine October supply levels.
The OPEC meeting, always important.
Always. And if they decide to boost supply again, the market fears it could outpace demand, potentially pushing prices lower. This also ties into that global growth narrative. Softer oil prices can sometimes signal concerns about weaker industrial activity or consumption worldwide.
It really seems volatility is the name of the game right now. So how can we gauge the overall mood of the market, beyond just the raw numbers? Are there tools that help us understand investor sentiment?
Yeah, the CNN Fear and Greed Index, though we don't have its live value right this second, is a crucial tool. It distills complex market psychology into a single, pretty understandable metric. It combines 7 diverse indicators, everything from market momentum, stock price strength, market breadth, put-call options, market volatility measured by the VIX, the CBOE Volatility Index.
Right, the VIX.
Yep. Plus safe haven demand for things like bonds, and even junk bond demand. It gives us this holistic snapshot of investor sentiment. Each component offers a unique window into whether the market is acting out of, say, exuberance or panic. While sentiment dropped sharply back in April due to those tariff shocks, it showed a significant recovery in August. And historically, periods of extreme low sentiment often precede significant market rallies. Makes it a contrarian indicator worth watching.
Okay, so understanding that index gives us a window into the market's sort of emotional state. What should we be watching for specifically in terms of volatility, especially as we head into the later months of the year?
Well, the VIX, which we just mentioned, it surged past 50 back in April during those tariff shocks. But it has been declining through August, suggesting a period of calmer waters, relatively speaking. However, market analysis strongly suggests we should prepare for increased volatility, particularly as we move into September and October. This isn't just a random prediction, it's a historical tendency. Markets often see swings and corrections during these specific months.
So a seasonal pattern to be aware of.
Exactly. So while things might feel a bit calm right now, probably shouldn't let our guard down completely.
That's an important heads up. And how is the Treasury market, often seen as a bellwether, reflecting these underlying forces, inflation, deficits, economic shifts?
The Treasury market is definitely sending some clear signals. The 30-year Treasury yield is currently at 4.892%. It recently flirted with that significant 5% level. Jamie Rush from Bloomberg Economics suggests that a 4.5% yield for the 10-year Treasury could well be the new normal, with potential to climb even higher 5.5% and beyond.
The new normal at 4.5%, okay.
And this upward pressure on yields is driven by several factors: persistent, sticky inflation, widening budget deficits in the U.S., and significant structural factors like demographics, and the increasing capital intensity of AI investment. The yield curve, notably, continues to experience what's called bear steepening. That means long-term interest rates are rising much faster than short-term rates.
Right.
This often signals expectations of stronger future growth, or perhaps more likely in this case, concerns about sustained inflation and just the sheer supply of government debt hitting the market.
That comprehensive view of the Treasury market certainly highlights the underlying pressures. So, given everything we've discussed, Fed policy, geopolitical tariffs, currency dynamics, structural shifts, what's the overall advice? Maybe some key takeaways for our listeners navigating this highly dynamic environment.
Well, based on the market analysis we've seen, investors absolutely need to remain sensitive to those tariff policies, the evolving Fed monetary policy, and the implications of rising U.S. fiscal deficits. Those seem key. For currency pairs, particularly USDJPY, given that political risk premium short-term range trading, perhaps between 145 and 150 might be advised. For USD, with its limited short-term upside, that tighter range of 1.10, 1.15 seems more likely. When it comes to U.S. Treasuries, given the risk of rising long-term yields that bear steepening we discussed, Jamie Rush's insights focusing on short to medium-term bonds, say 5 to 10 years, could help mitigate some of that interest rate risk while still capturing some yield. And for U.S. stocks, the S&P 500, especially with that September-October volatility tendency, emphasizing quality stocks, companies with strong balance sheets, consistent earnings, that becomes paramount, alongside diversification, of course, and continuously monitoring those AI-related stocks and earnings, which remain a really powerful narrative.
That's incredibly practical advice. Helps connect all these dots for us. Finally, let's quickly turn to the upcoming economic schedule. Based on investing.com, what are some key events we should be paying close attention to in the days ahead?
Certainly. Today, September 4th, 2025, at 8:30 a.m. US ET, we're watching for U.S. jobless claims, which we just covered. And then at 10 a.m. US ET, the U.S. ISM services number will be released. That'll offer more insight into the health of the non-manufacturing sector.
Okay, ISM services, important one.
Definitely. Looking ahead, tomorrow, September 5th, brings the crucial U.S. employment report. That could significantly impact Fed expectations one way or the other. And further out, next Friday, September 12th, will feature Fitch's latest rating announcement for France. They're currently on a negative outlook, so that could have some ripple effects in European bond markets.
Good to keep an eye on that Fitch rating for France.
Absolutely. And if we just connect all of this back to the bigger picture, it's really evident that we're navigating this incredibly complex interplay of economic data, central bank policy, these huge technological shifts like AI, and ongoing geopolitical tensions. Understanding these forces and their potential implications, rather than just reacting to every single headline, is really crucial for developing a well-informed and hopefully resilient perspective.
So what stands out to you most from today's deep dive? I mean, as we've explored the push and pull of Fed independence, the sort of nuanced market dynamics in Asia and Europe, that ever-present shadow of geopolitical risk, it truly underscores how interconnected and, frankly, how fascinating the global financial system is. It makes us think, How might these ongoing trends, particularly maybe the Fed's internal divisions, the global trade disputes, how might they shape our own understanding of risk and opportunity in the coming year? What's the biggest takeaway, and what will we be watching most closely? Thanks for watching. Don't forget to like and subscribe for more deep dives into the financial markets.